Okay, this might really sound very simplistic, but once you've done your SWOT analysis and you're looking at the different alternatives to go forward, one of the things that we usually look at is whether we're going to be more risk-seeking or risk-avoiding. Risk-avoiding is where we have some sort of competitive advantage and we just want to milk it, right? We're not trying to expand in new markets or take customers away. We're just trying to get as much out of it as possible. Risk-seeking is we're trying to strengthen that competitive advantage, make it into a sustainable competitive advantage, or take advantage of the situation. I don't know. Why? But there's different ways we look at it. Strategic reference points are one of the ways we can help us decide whether we're going to be more risk-seeking or risk-avoiding. Basically, we have usually a company that we say, this is who we compete against. And if we are really satisfied with the current situation, we think we're just in a good place. We're having above average profits, we're beating our competitors, things are going well. Normally we will take a more risk avoidance type of stance where we'll just relax and enjoy it, right? Enjoy the profits. We can focus on improving internally, like improving our supply chain, maybe reducing some costs, but we're very careful about our quality, that type of thing. It's we're looking at improving our processes, improving our employees. But if we're on the other side, where we think we're kind of on this little guy at the bottom, where we think that our strategic reference point, whoever that might be, is doing better than us, then we're not satisfied with the current situation, and we're looking for opportunities for potential gain. We're going to be more risk-taking, looking for niches that neither we nor our competitors are taking advantage of, that type of thing. Now, sometimes these things can fail for us. One of the interesting articles I read recently in Bloomberg was about this McDonald's owner. He had been working for McDonald's for about 40 years, and he owned his own McDonald's, and he sold out because McDonald's had changed things so much that where it used to be a very simple business to run, now it was becoming very hectic. Order times were taking longer. We had more customers waiting in line. Then he was like, and now they're going to put in this breakfast any day. And he said that doing that, breakfast any day or any time of day, means I have more items available. I have more setup time. I have more, just a lot more of things to juggle throughout the day. And to him, it was too much. He wasn't making as much money as he needed to for it to be worth it. So here's McDonald's, probably not particularly comfortable with their current situation. I'm not sure who they're referencing. I mean, maybe Taco Bell, but because they're beating Burger King for sure. Maybe they're just not receiving the profit margins they are. But they need to understand the economy has expanded. And normally when an economy expands, people will not be so price conscious and go to McDonald's, but if I have more money, I'll go someplace a little nicer, like I like In-N-Out or Habits or something like that, where you just have a little bit better quality of food. Because I have more money, I can afford that, and that's probably why McDonald's is seeing their profits or their sales income shrinking. And that's why they're taking these risks by bringing in, and it is a risk to bring in a breakfast and serve that all day. Okay. At the corporate level, so we're talking CEO again, they're looking at the big picture. What business or businesses are we in or should we be in? And what markets should we be in and are we in? Right? And this is maybe a change, but since we're a global economy, global markets are important to us. Especially like GE, they sell, not GE, but GM, the automobile manufacturer, sells more cars in China than they do in the U.S. And that's important. They have a bigger market in China than they do in the U.S. They started manufacturing over there so they could sell. If they didn't start manufacturing in China, China wouldn't have let them sell their cars there. So GM, looking at the global situation, said we need to start manufacturing in China, not only to take advantage of the cheap labor, but to get a door in so that we can then sell our cars there. We're going to talk about a portfolio strategy. So it's a corporate level strategy that minimizes risk by diversifying investments among various businesses or product lines. So there's two types of diversification. There's related diversification and unrelated diversification. And sometimes we diversify through acquisition. And sometimes we just grow through acquisition. I might be a small cable company in Illinois, and I want to increase my market share, so I just buy another small cable company. And that's one of the ways I can grow. So these are some of the things that we're looking at. Now there's this thing called, or a group called the Boston Consulting Group. Let me see if I can blow this up a little bit. They'll take the assets of a company, and most large companies have a lot of different small business units. So we're looking at the very small business units or product lines within a company, and we're going to categorize them into these four main categories. We have cash cows. A cash cow is something that has a great track record, has great profit margin. We have it down pat. We have great quality. We know why we have great quality, and we're going to continue to have great quality. So that's what our cash cow is. We have dogs that are losing money, right? Question marks are potentials, right? So the question marks are maybe new investment that, like Uber, would be a question mark. Now it might be a star. So we would take the money that we have from our cash cow, and a star is a company that has above average profit margins, way above. And it might be a star just for maybe a year, maybe 2 years, and before it loses its competitive advantage. So we want to take advantage of that as long as we can. So what we'll do is we'll take money from our cash cow, instead of reinvesting into the cash cow through further development. It has a steady product line, like maybe Silly Putty. Silly Putty, well, actually I haven't seen it in a while, but it used to sell all the time. That was one of the things you got. Take the excess money from that, and you invest it in your stars so you can take advantage of that higher profit margin while you can. And you also invest it into these question marks that have the potential to become stars. Right? Again, what do we do with our dogs? We get rid of them. And one of the interesting things that they found is we want a diverse portfolio. You might think of this in your stocks, right? You want a diverse portfolio in stocks so that if one stock takes a hit, the other stocks will make up for those losses. What they found is that the risk decreases when we diversify in related fields and increases in unrelated diversification. For instance, Warren Buffett, he did not invest until IBM in IT stocks. You might even say IBM, by the time he invested in them, wasn't an IT stock. But that's Warren Buffett. He doesn't know IT very well, so he's going to invest in companies and in businesses that he understands. He invests in good management groups, or in management groups that he thinks that he can influence to become good. So he has a fairly narrow mindset on what to invest in. And so even though he's diversifying, they're related, right? As soon as he goes into IT and that type of thing, he gets into unrelated diversification. So a single business, if I'm only investing in one stock or in one single business, I have a high level of risk. That goes down when I have different small business units that take care of different customers or different customer markets. For instance, when I was working at Varian Medical Systems, one of the things that we saw when Obamacare was coming in is no one knew what the effects would be. So sales for our high-end items throughout the United States plummeted. They would buy replacement X-ray tubes from us, but for the big cancer-fighting treatment labs and stuff like that, they didn't know if they're going to have the funds for it, so they stopped ordering or canceled orders. We didn't have that problem in Europe. And in that way, you can say we had a related diversification. Still cancer fighting, still X-ray tubes, but the diversification came in the different market segments. So we're selling in the United States, we're selling in Latin America, we're selling in Europe, we're beginning to sell in India, and we're beginning to sell in China. That's related diversification. Okay. This video is running long, so I'm going to stop here. We'll pick up in just a minute.